In this week's update, US recession fears fade, the Fed starts with a bang. The big stunning action in local small caps, and gold sets a new high. My name is Garry Davis, and I am an authorised representative of Primary Securities Ltd. The information presented is general advice information only and takes no account of your financial position, your objectives, or your needs. Before acting on any advice, consider if it is appropriate for you. Last week, there was a major turning point. It's been building up for probably 12 months, I guess, but really intensified in the last few months. Would the Fed cut rates? By how much? It's been the ongoing debate, and the market has been flip-flopping backwards and forwards on expectations as they changed. But we finally got the answer, and it was a significant turning point in the market. And the Fed basically did what was expected, what the market was demanding of it, and that was they cut by 50 basis points. And they also slashed future rate projections as well, which gave a higher probability indication of at least another half a point rate cut by the end of the year. Whether that comes as 2 further quarter percent cuts or not remains to be seen, but this was exactly what the market was looking for. The Fed went on to say that economically things were pretty good, but when you stand back, they must be seeing some risk because they've cut by 50 basis points. Otherwise, there was no justification for doing so. But the narrative that the Fed put out there, which the market initially responded a little bit negatively to, but then turned around abruptly. But the narrative that the Fed is putting out there is that their inflation is allowing them to do things to get ahead of the curve. And often central banks are not in that position. They're kind of caught between a rock and a hard place. But inflation has certainly moderated significantly enough that the Fed can now not worry about policy settings and their impact on inflation. And they've now turned their attention very much to the other part of their mandate, which is about employment. And so that's very much what the 50 basis points were about. And what the Fed said was, we see downside risk to the labour market and we're moving to a more neutral setting. So that was pretty good news initially, and that's why the initial market reaction was a little weird, to say the least. The market fluctuated quite a bit on the day, went up, and then it went down and finished negative. So ebbing inflation is allowing the Fed to act to preserve what they've got before it deteriorates. Now, there are many commentators in the market that are saying the Fed has waited too long, that the lag effect, unemployment is going to get sharply worse, and the US is going to go into recession, all the rest of it. And look, no one really knows until the time comes because there is such a lag factor in there. You've got to really follow the money and follow the trend. The smart money has a much better idea of what it's doing than the media and the general commentary does. And so far, the market reaction has been very, very positive after that initial strange response. So we saw a whipsaw on the day, and then the market absolutely took off to the upside. It started in the futures about 4 or 5 hours before the US market opened on Thursday. The futures just really took off. Thursday was a big day, and Friday did nothing to unstitch that. So the market, you've got to say, the way forward for the rest of the year is pretty positive. Now, one potential little thing to be aware of is that the final 2-week block of September is historically the weakest 2-week block of the year. Now, it's not 100%. There are years when that is not the case, and this could be one of those years. But you've just got to recognise that the odds are not overwhelmingly in favour of the market just charging up over the next couple of weeks. So just exercise a little bit of care. So that's one part of the word of caution. Also, the US results remain a bit mixed. This was out of the main earnings season, but FedEx, which is the world's largest goods transportation, parcel transportation companies, they missed earnings and they lowered guidance. Even worse was the lowered guidance, and the stock got absolutely belted, down 15%, which is a lot for a stock that has a market cap of $62 billion. And they're regarded as a real bellwether for the economic health globally because they go everywhere. So there are certainly still mixed results. So you've got to be careful on that respect as to what stocks that you're actually selecting. The second thing is we look at the US market valuation, and most of the models are indicating that the US market is fully valued, call it expensive, to overvalued, particularly the Cape-Shiller ratio. But these are all backward looking. I've always had a problem with the focus on these backward looking models that don't necessarily tell us about the future. But nevertheless, we're at a point in time where the FedEx result maybe just introduces a little bit of doubt, a little bit of uncertainty about the strength of global economic activity. And it's at a time when the backward-looking models are looking very expensive, so that could be important. The most important thing is what will the growth be going forward, and that's still a bit of an unknown because we're just at the start of a rate-cutting cycle. Has the Fed waited too long, or have they got it right again? You'd have to say, after decades of pretty average central bank results and management around the world, that the Fed Powell has actually done a pretty good job over the last 3 to 4 years. So who's to say that the Fed doesn't have it all under control and the growth in America will be pretty good? But certainly there are other spots around the world where that's not the case. So from my perspective, it's far safer to focus on individual stocks and manage them well. So you need to buy into stocks, and I'll come back to this point. You need to buy into stocks that give you the greatest probability of strong future growth and just manage them well via the way you enter, the way you take profit, the way you manage your weightings, all those things that are within your control. Yeah, so don't ever feel like you're a victim to what the market is going to dish out, because that is absolutely not the case. We can actually control a lot of the things that go into moving share prices up and down. It's all about understanding the process to do it. But what I can say is that there is a huge bifurcation in the US market. There are stocks getting great results and are trending upwards very, very powerfully, 20, 30% in a week. And these are stocks of some substance. These aren't micro-cap stocks. These are stocks of 10, 20, 30 billion market cap. So we've got those sort of trends, but equally we've got the FedExes and many others that are getting absolutely slammed. So you've just got to be very discerning in what it is that you go with. So American stocks, the S&P rose 1.35% for the week. The NASDAQ was up almost the same amount. And that built on the big reversal from last week. The fact that the S&P and the NASDAQ were almost similar, and the equal weight S&P was almost exactly the same as well at 1.4. But the rotation into smaller caps continues. The Russell 2000 IWM was up 2.2%. And I hardly do any really large mega cap stocks in the US. Just one or two here and there. Most of my focus is on the smaller end, from generally 50 billion market cap down to say $1 billion. And there's no question when you look through 100 plus charts that the rotation to the smaller end is continuing with great gustos. It's very encouraging for the US market. And it's very encouraging for our market as well, because the US market sets sentiment for the world. And sentiment does impact what the market does. It's not just about the valuations and the fundamentals. So a pretty rosy picture coming out of the US with some caveats. Now, the US dollar index was lower at 100.73, so we're getting down to that key 100 level, and there's not much bounce, and nor would you expect it given that the Fed is now well and truly into their rate cutting cycle. The 10-year yield was up a little bit. It was about 3.65 last week, up to 3.74. The VIX dropped a little bit further. So that was the US market. Let's go and look at some charts. So there's the S&P on a weekly, just finished a little bit off its highs for the week, but you can see over the last month, we've actually gone up. So we had a huge sell-off week in the week of ending September 6th. Then we got virtually a complete reversal of that the following week, and then good follow-through in the week just gone. So it's all pretty positive. RSP, you can see, had a good week, and also the Russell as well. Let's go back, just quick check on the NASDAQ. So these are all looking pretty similar. The S&P was new all-time highs, the NASDAQ not so, and that's heavily about big tech being sold off. And whilst semiconductors have steadied, the money is not exactly roaring back into them, which is telling. So the character of the market has changed. This has not been an immediate reversal back into what has been over the last year and a half. And if we look at the spread, it's all you can say at the moment is that semiconductors, which have been a significant leader in the market for quite some time, they've steadied relative to the rest of the market, but the money flow has hardly gone charging back in. This is consumer discretionary versus consumer staples. Definitely a definite significant improvement in that ratio, and that ratio is obviously important as well. So what we don't want is to see a peak like this that we got at the end of 2021, and that was in advance of the market rolling over. So this was the big leading indicator for the absolute smashing of technology during 2022. You could do a lot worse than tracking this particular ratio. So we've gone sideways now since July of 2023. So we're looking at nearly 15 months. But we've picked up in the last couple of weeks. So that's the important thing. If we look at that on a sector-by-sector basis, consumer discretionary has rocketed to the top. It was only a few weeks ago that in early September that we were trading down towards the lower end of the pecking order. Consumer discretionary has roared up. Finances continue to do well. Materials on the back of gold has certainly helped there, and steel. And then we drop down to staples and communication services, and then healthcare. And interestingly, technology, XLK, is rising, but it's still lagging over the last month. So just reinforces what I said before. Looking at Australia, finance has had a great time of it, and I've got some more to say on that in a minute. Information technology also continues to do well, trending very, very strongly. Small caps picking up also in Australia, followed by materials, and then we've got healthcare lagging just a little bit, and energy the bottom of the pack. If we look at the currencies, US dollar sitting right on its key support level. So if that breaks, then we could get a sharp move down in the US dollar. It's one to watch. And of course, the Australian dollar is doing just the opposite, and it's risen to a point of likely resistance, where we're key support and resistance levels in the currency. Turning now to the Australian market, our dollar at 67.5. The ASX 200 rose 1.3%. It rose every session last week, which is pretty impressive. But I'm not taking any great comfort from that, because a lot of that drive is coming from the banks. And I think that the banks are at dangerous valuations. And the rest of it was coming from a bit of a rebound in the major resource stocks. And there's got to be a big question mark over the price of iron ore, which feeds into those large resource stocks. So I don't feel at all comfortable with the ASX 200 at this. But do I see opportunities within the Australian market? You bet I do. And certainly the trends show that. So the leaders last week were the banks, IT, materials were the main leaders. But look, I've got to just single out CBA, and I don't want to be a bank basher here, but to me, it just feels as dangerous as NVIDIA did 6 months ago. And let me explain why. But before I do that, I just need to remark that there are just so many powerful small cap trends. It's incredibly exciting at the moment. I can't remember a time when there were just so many really good small cap trends. You know, particularly when we're not in a raging bull market sentiment. It just isn't. It's been very disconcerting sentiment, if you like. But let's take a look at CBA. Now, if we look at the earnings, consider the earnings growth. In 2014, their declared earnings were $5.22. In 2024, it was only marginally higher. Now, I know they pay out 80% of their profit in dividends, but these are the facts. And in 2026, the forecast is for $5.88. So at the earnings per share level, the earnings are not really rising that quickly. They're certainly not rising nearly as quickly as the share price. So therefore, the PE ratio has to go up, and we'll get to that. But let's look at the main reason that a lot of people invest in the banks, and that's for the dividend. And if you look at the last 10 years, the dividend in absolute terms, in total, has gone up 16%. Now, how much has inflation gone up in the last 10 years? I don't know what the number is, but I can tell you it's a heck of a lot more than 16.8%. So in 2014, they paid $3.98, which was a payout ratio of 76%. And the yield at the time was almost 5%. In 2024, they paid out $4.65, which was a slightly higher payout ratio, but the yield had dropped to 3.34 because the price has gone up so much. So when we look at valuation, the banks in general over the long term tend to fluctuate in a PE band between about 10 and 16. That has been the historical PE band that the banks have operated in. Now, when you look at CBA, over the last 20 years, it's fluctuated between 10 and 25 now, but it's only the last couple of years that it's moved to those levels. Before that, if you go back pre-2020, I can't remember a PE ratio above about 18 at the peak, when the market was very good. So we're now trading at historically significantly higher PEs than normal. We're right at the top. 25 times is where we currently sit. So when I put all that together, I can't believe the way the Australian economy is set up at the moment, that 25 times PE for Commonwealth Bank and a lower number, but still historically high for the other banks. I just can't see that this is the environment when banks should be trading at extreme PE levels. So I see significant risk in the banks. So that's just an objective perspective on the Australian market. We'll have a look at the trends in those indices when I go back to the charts, but let's just do precious metals. Gold was higher by $43, so we've broken through 2,600 and finished at 2,622. Very good week. Translate that to Australian dollars. We got a small rise in Australian dollars because obviously our currency went up as well, but it's still very, very buoyant. And there are numerous very, very good gold producers in Australia that have all-in sustaining costs around about the 1,800 to 2,200 level. So they're extremely profitable. And I still find the response in the market to Australian gold producers as being somewhat disappointing. Now, silver also gained again 31.17, and all this euphoria, if you like, around the precious metals prices, more so than precious metal stocks. But the underlying commodities are about the rate cuts, obviously, a much better environment for gold and silver, but also the tension in the Middle East, which is just continuing to ratchet up. If we look at XGD, which is Australian Gold ETF, it was up 1.2% for the week. I thought it could have done a lot better than that, should have done a lot better than that, given the leverage between stocks and commodities. So the market's still being a bit cautious. If we look at GDXJ, which is really the global scene minus the absolute majors, such as Barrick Gold and those sort of stocks, Newmont, then GDXJ was mildly higher as well. But in Australia, there are some select small caps that are giving us extreme leverage. And so there are a small handful, it's certainly the minority, but there are a small handful of very good performers in the Australian market. But you've just got to be really very selective when it comes to gold stocks. So let's just check in on a couple of charts. There's the ASX 200, new breakout high. So that's pretty impressive, but frankly, I don't trust it, but it doesn't really matter because I don't trade the index anyway. Let's just quickly run through the sectors. Energy in lots of trouble with the crude oil price down. There's the banks. It's been an absolute tear. They've moved from 6,200 points to 8,570 but it's basically this year. That's pretty much year to date. Now, given the way that the Australian economy sits, the interest rate situation, current government policies, it's very hard to feel confident about the buoyancy of the Australian economy. So to me, this is the most dangerous part of the Australian market. Healthcare had a bit of a pause, not much happening there, but certainly continues to power on. It did very well, and there's materials. Bit of a bounce back with iron ore, but you've got to say we're forming lower highs and lower lows. We're now trading below all the moving averages. All the shorter-term moving averages are now rolled over. This is the 200-week, which is obviously an extremely long term. But all the other moving averages are all turned over. This is the 50-week, which is analogous to the 200-day. So materials is definitely in downtrend, question about it. Now, if we look at the precious metals, there's silver. We're picking up again. And if we take a bigger picture view of silver, you can see there was the absolute spike highs in 2011. We've still got some work to do, but we are breaking out. So this was a pretty key area here around $30. It's definitely starting to look a little better. And if we look at gold in US dollars, this is a weekly chart. You can see we've had a couple of very good weeks. We may get a pause in the next week or two, but that's looking very, very powerful. And in Australian dollars, it's being held back a bit by the rise of the currency, but still it's very profitable territory, that's for sure. All right, moving on to other commodities. Copper was up to $4.28. Nickel also up from around $7.10 to $7.36. And crude oil was back to 71. So there's the copper chart. We're now getting back to shorter term highs. So that's a head back in a positive direction. But look, we've still got, as I mentioned earlier, with FedEx, which is a bit of a bellwether for global economic health. Copper is not going to do well when global economic health is under question. No matter what you might think about the energy transition, it's just not going to happen for copper while economic activity is under pressure. And you'd have to think that the FedEx result is a pretty good indicator of that. And there's the crude oil chart. A bit of a bounce, but certainly in the medium term. We've been on the slide since around 87. Wrapping it all up, the way forward is now a lot clearer. It was a major turning point last week. That doesn't mean that the market won't be volatile, that we won't get some significant sharp sell-off days or weeks. The next 2 weeks is critical. So the market certainly has some historical risk in the US. But you've got to say, looking out over the next 3 months to the end of the year and into next year, the way forward is now clear. We've been under a rising interest rate cycle for some time, quite a significant interest rate raising cycle to combat inflation. That is now turned. And the indications are that it could come down quite quickly. So I think the way forward is clear, but the FedEx result shows that there's still plenty of risk out there. Stock selection is just absolutely critical. So what do you need to do well in this sort of market? I think the first place I'll always go is strong trend, because if you start with the fundamentals, there are a lot of good stories out there where the price is just not moving according to what the fundamentals would indicate. So I always start with a strong trend. If a trend is strong, there's generally a reason for it. Now, sometimes the trend goes up very strongly and the financial fundamentals are terrible. But you get to that as the secondary filter. Start with stocks that have got upward momentum. Don't try and pick the bottom, because that's, to a degree, that's a bit of guess and a bit of luck. So start with a strong trend. Secondly, identify the stocks that are trending strongly, that have got very compelling and high probability fundamentals. You've got to have those two things. There's plenty of stocks that have got lots of potential, but the probability of them realizing that is nowhere near as high. So compelling and high probability fundamentals. Third, sensible valuation. Now, often you have to pay up for real quality. So don't hesitate to buy stocks great stocks that might be fully valued, because long history shows that some of those stocks can just continue to be expensive for years and years and decades. Stocks like of the ilk of CSL, for instance, always been expensive, probably always will be because it's a quality stock. And sometimes you've just got to pay, in the words of Buffett, you pay a fair price for a great company. So sensible valuation. And then the final ingredient in the mixing bowl is outstanding management. And I absolutely love, I get much more enthusiastic when a smaller cap business, which is still founder-led, that has a lot of skin in the game, that's a huge bonus because the track record around founder-led businesses that dominate their niche is incredibly good. So that's the way forward, in my view. Portfolio analyst last week, we did look at a very compelling long-term investment opportunity, and we looked at the process of investing through central bank uncertainty, and we had that up until Wednesday of last week, but that has now pretty much been cleared. And distinct from a number of previous Fed meetings, the narrative that followed the announcement, so the press conference after the announcement on the rate cut, was much, much clearer than we normally get. And certainly Powell was pretty balanced, but he was generally pretty positive about where the US economy sits. So it's not Goldilocks land, but it's pretty good. And good stocks that should go up, now have the way cleared. I think that's the message. So that's it for this week. There's more information on the website. There is my email address for anyone that wants to communicate with me. And I'll be back with you next Sunday. Cheers.